Hello everyone, welcome to this session. In the previous sessions we have discussed various aspects of regulations, what are the rationale for regulations in financial market, and then we started discussing some of the types of financial regulation. So, one of them was the capital requirements, and we discussed the capital requirements in the context of Basel framework, and we discussed Basel 1, 2 and more importantly Basel 3, that is the recent one. So, in this session we will discuss other aspects, other types of regulations. The one is here the prompt corrective action, shortly this is called PCAs. So, in a nutshell, prompt corrective action means intervention, an early intervention by the central bank when they see that, when they get a signal that the bank, the commercial bank or the financial institute, the bank, concerned bank is going to get into trouble. A kind of banking crisis is going to pop up. So, based on that signals, the Reserve Bank of India, in the case of India, the Reserve Bank of India makes early interventions. So, this is a framework, prompt corrective action is a framework for intervening, for the early intervention by the central bank in the working of the respective bank. So, prompt corrective action provisions that require, in the case of US is FDIC, in India is RBI, to intervene earlier and more vigorously when a bank gets into trouble. So, the prompt corrective action or PCA is a framework under which banks with weak financial metrics are put under the watch by the RBI. The PCA framework deems banks as risky if they slip below certain norms on three key parameters. One is capital ratios. This you are already familiar, we discussed in the previous class session, that means what is capital adequacy, capital ratio, etc. And second one is the asset quality, and the third one is the profitability. So, let us now see the Reserve Bank of India framework of PCA. So, about the prompt corrective action framework of the RBI is an essential element of RBI's financial stability framework. I would suggest you visit RBI website, and there you will get lots of information about the PCA framework. So, this one a structured early intervention and resolution by regulators for banks that become undercapitalized due to poor asset quality or vulnerable due to loss of profitability. This is, I am putting here a screenshot of the PCA framework of the RBI. Here you can see that mainly there are three parameters. One is capital to risk weighted ratio and non-performing assets, and third one is return to assets. So, the first one is, you know that this is the capital requirement, the first one CRAR. This one is the capital requirement, and second one non-performing asset, this is about the quality of assets, and this one the ROA, this is about the return on asset, this is about the profitability parameter. So, coming to the first one CARAR, this if it is less than 9% but equal to more than 6%, then bank needs to submit capital restoration plan, restriction on RWA expansion, entering into new lines of business, accessing or renewing costly deposits and CDs, and making dividend payments. So, order recapitalization, restriction on borrowing from interbank market, reduction of stakes in subsidiaries, reducing its exposure to sensitive sectors like capital market, real estate, or investment in non-statutory liquidity ratio securities, etc. If the CRAR is less than 9% but equal or more than 6%. So, these banks, these are the restriction for if it is coming above 6%, but below, if it is below, there are other restrictions comes, it means they are going to even tighten up their restrictions. Then means actually the RBI's watch or RBI's regulation monitoring will become more and more stringent on the concerned banks. Even look at, for example, if CRAR less than 3%, this time is really the bank is under the strong PCA framework. That means in addition to the actions hitting the first and second trigger points which we mentioned, in addition to all these, more close monitoring, that is the key important things here, that the RBI's frame that monitoring, it become more close monitoring under the PCA, steps to merge, amalgamate, liquidate the bank or impose moratorium on the bank if its CRAR does not improve beyond 3% within 1 year or within such extended period as agreed to. So, you can look at from here, that means when the bank's capital to risk weighted asset ratio, that is CRAR, if it is below 3%, you know that eventually RBI is getting the signal that actually the bank is going to fail, maybe within a couple of months or within a year the bank is going to fail, that the probability of bank failure is very high. At that time, Reserve Bank actually using the PCA framework to impose all these conditions so that bank failure can be prevented, the bank loss, that the banking crisis can be averted. This is one intervention, one of the key component. And the second one is about the non-performing assets of the bank. So, if the non-asset performing assets, that suppose the loan quality is very poor, the asset quality is very poor, then the banks will be having more and more number of, suppose of the all loans, if more percent, for example, if net NPA is over 10% but less than 15%, that means is an indication that bank's financial health is under risk, right. That means of the all the asset, if around 10 to 15% is the NPA, that means non performing asset, then RBI will do that. As per the PCA framework, special drive to reduce NPAs and contain generation of fresh NPAs. So, one is to reduce the NPAs, another is preventing the generation of fresh NPAs. Maybe the NPAs mostly it comes from loans. So, one is to reduce that loans, another do not give loans to that particular sectors or particular with those kind of borrowers who is having high risk. So, review loan policy and take steps to strengthen credit appraisal skills, follow up of advances and suit fill decreed debts, put in restriction in entering new lines of business, making dividend payments and increasing its stakes in subsidiaries. So, that means restriction in all these lines, that new lines of business, dividend payments and increasing its stakes in subsidiaries. If net NPAs become more than 15% and above, in addition to action hitting above, bank's board is called for discussion on corrective action plan by the RBI. So, similarly, this is about the net NPAs part. If it is becoming more than 15% of the NPAs are 15% of the total assets, then the bank will be called by the PCA secretariat, PCA board, PCA framework. Under this framework, the bank's board is called for discussion on corrective plan of action by the RBI. And coming to the ROA, if the profitability, that the return on assets. So, here also if the return on assets is less than 0.25%, then lots of restriction will be put on the concerned bank who is having ROA less than 0.25%. Then you can say that restriction on accessing, renewing costly deposits and CDs, entering into new lines of business, banks borrowing from intermarket, this kind of restriction will come up, even including dividend payment, expanding its staffs and etc. So, these are all the restrictions that will be put on if the NPAs are below certain threshold. So, we can see here that these are all the restrictions that they put, these are all the prop corrective action. Again that this is about the RBI framework, RBI PCA framework. In FDIC in the US, these are all the framework they use. That means well capitalized, under capitalized, they make a categorization. They make a 5 PCA categories like that, well capitalized, adequately capitalized, under capitalized, significantly under capitalized and critically under capitalized. And you please visit this website, this link, and you will get further information about the FDIC PCA framework. To get more idea about the PCA framework in India, I would suggest there is a brilliant article, excellent article written by Dr. Viral Acharya. This has been already freely available for download. Here Dr. Viral Acharya, he clearly explained what is this framework is all about, why is important. Actually, the PCA framework prior to Viral Acharya term in the RBI, I think it was not well received, this PCA framework, and his writings actually highlights why we need PCA framework, and in order to prevent the bank failure, in order to ensure that the bank's financial position is sound, is on track. If there is a problem, we need to make early intervention. So, I would suggest you read this article and get more clear idea about the PCA framework in Indian context. So, I am just also giving some screenshot just to see that you can read the PCA framework related news in the financial dailies. For example, this is the one where it says that 3 public sector units banks are likely to be out of PCA framework by March. That means once they meet the regulatory requirement, or the 3 framework that we mentioned here, the capital adequacy, asset quality and profitability parameters, once they start performing well in this, they will be out of this monitoring or this PCA framework. So, let us now move to the another type of regulations, that is called restrictions on asset holdings. So, here the bank's regulations that restricts asset holdings are directed at minimizing the moral hazard problem. That means because of government safety net, we know that government safety net encourages banks to take too much risk, which we already call that that is nothing but moral hazard problem. So, bank regulation that restricts asset holdings are directed to minimize this kind of moral hazard problem, because we already seen that moral hazard problem is costing taxpayers dearly. So, one of the strong rationale for government regulation aimed at reducing risk taking on the part of financial institution, and therefore even existed before the establishment of government safety nets like federal deposit insurance. That means it necessitates a bank regulation, because in order to prevent this moral hazard problem. So, here bank regulations actually promote diversification. It promote diversification which reduces risk by limiting the amount of dollar in particular categories or to individual borrowers. The point that we discussed in one of the previous sessions, that means risk reduction through diversification, maybe hedging or spreading the risk. In that way, central bank asks the member banks to do the diversification. That means promoting diversification becomes one of the component of restrictions on asset holding. That means part of the regulation that is actually here restrictions on asset holdings. And another thing is banks are restricted, prohibited of holding common stocks. They are not allowed to invest in common equity. They are not allowed to invest in equity. So, instead mostly you can see that if you look at the bank's balance sheet, most of their investment in addition to loan, it will be on government bonds, mainly in the bond market. They are not allowed to invest in the equity market. Fourth component, another types of regulation is called financial supervision, which includes financial chartering, and examination. Chartering financial institutions is one method of preventing adverse selection problem. Because of government safety net, we have seen that financial institution can be used by maybe the crooked or over ambitious entrepreneurs to engage in highly speculative activities, such as undesirable people are often eager to run a financial institution. Right. So, we have seen this point, that means more risk loving people and more people, those who more likely to engage in moral hazard behavior, are more likely to enter in the banking industry because of the government safety net. So, they find banking sector is one of the attractive business sector for them. So, in this case, what central bank will do, they will do chartering of financial institution. So, So that means a commercial banks obtain a charter either from the controller of the currency or is the state the concerned banking authority in the respective jurisdiction. So to obtain a charter, the people planning to organize the bank must submit an application that shows how they plan to operate the bank. So in evaluating the application, the regulatory authority looks at whether the bank is likely to be sound by examining the quality of the bank's intended management, the likely earnings of the bank and the amount of the bank's initial capital. So that means screening of proposal to open new financial institution to prevent adverse selection. So more importantly, by preventing undesirable people owning them. So in this case, bank will RBI will ask for we will engage in chartering financial institution. So the second component is examination, that means scheduled and unscheduled, to monitor capital requirements and restrictions on asset holdings to prevent moral hazard problem. So that means regular on-site examination which allow regulator to monitor whether the institution is complying with capital requirements and restrictions on asset holdings and function to limit moral hazards. So bank examiners give banks a CAMEL ratings and this acronym is based on the 6 areas assessed. One is capital adequacy, this you are familiar already. Then the asset quality, this also the NPA part, asset quality. There will be bank examiners will be monitoring this, assessing it. Then about the bank management, the quality of the bank management, liquidity of the bank and sensitivity to market risk including interest rate risk and inflation risk. So these are the CAMEL framework through which the examination will be done, the assessing the bank examiners assessing the banking system, and accordingly they will be getting the ratings. This is called CAMEL's ratings. So in addition they will be asked to fill periodic code reports so that the central bank can come to know or clearly monitor the bank's performance, bank's financial conditions. Then another type of regulation is the assessment of risk management, and here greater emphasis on evaluating the soundness of management process for controlling risk. And that because of the financial innovations and with the objective to earn more and more profits, banks will be entering to multiple activities in addition to their conventional activities of accepting deposit and lending loans. So we have seen that they will be entering into trading activities, many speculative activities. So in this case the risk management of the bank is important because this change in the financial environment resulted in a major shift in thinking about the prudential supervisory process throughout the world. So bank examiners, for example, now place far greater emphasis on evaluating the soundness of a bank's management processes with regard to controlling risk. So here there are several elements of sound in assessing the risk management of the bank. One is the quality of oversight provided, and the other one is adequacy of policies and limits for all risky activities. Then third one is quality of risk measurement and monitoring systems, and the last one is adequacy of internal controls. So these are the 4 elements of sound management that assess to arrive at the risk management ratings. So even quality of oversight provided, this by the board of directors and senior management, because mainly the question is about the management. And about the second one, adequacy policies and limits for all activities that present significant risk, so that also will be assessed. Then the adequacy of internal controls to prevent fraud or unauthorized activities on the part of employees, and this also measured in terms of the management plans. So what are the measures are being taken by the bank's management in order to reduce the interest rate risk? That also will be assessed. The internal policies and procedures used for that is laid down for assessing in order to address interest rate risk, and internal management and monitoring. And similarly, particularly important here is one more thing is that actually particularly important is the implementation of stress tests which calculate potential losses and the need for more capital under fictional dire scenario, that is implementation of stress testing for the banks, and also the value at risk calculation, which measure the size of the loss on trading portfolio that may happen 1% of the time. That means the worst possible scenario of loss that the bank going to face, that also will be measured under this framework, that the assessment of risk management. Then coming disclosure requirements, here requirements to adhere to the standard accounting principles to disclose wide range of information. So you know that the Basel II is known more for the importance of disclosure requirements and supervision of the banking system. So in US this Act, Sarbanes-Oxley Act of 2002 established the Public Company Accounting Oversight Board. So this is another kind of regulation. Coming to the next one, this one is called Consumer Protection Act of 1969. In the US there are a series of legislation to protect the welfare of the investors, that the Consumer Protection Act, that is Act of 1969, Fair Credit Billings of 74, Equal Credit Opportunity Act of 1974, and Community Reinvestment Act. And all these actually relevant because the subprime mortgage crisis illustrated the need for greater consumer protection. Then coming to one more, the last one, that is actually the restrictions on competition. So one is this, because one of the reason this has been found that one of the reason for banks to enter into new arena of business, new areas of business, is because of the increase in competition. That is increase in competition. So because of high competition, the profit declines. So banks were they were looking for more and more new areas of businesses that actually make them more vulnerable to high risk, and that actually makes the bank crisis, leading to banking crisis and banking failure often. So however, you know that actually this is actually sometimes we mostly what we know that, or we always see that increased competition, that when the sector, financial sector, is more and more competitive, that is actually considered as a welfare gaining proposition, because actually more competition in most of the economic theories is argue that actually competition promotes welfare, be it for the consumers, be it for the producers, and for the entire society. However, with regard to banking sector, sometimes empirical evidences suggest that it's not always true. So in that way, but not to completely eliminate, not to promote monopoly or oligopoly market, just to minimize that competition, because if it is adversely affecting the bank's profit, then actually it just justified as increased competition, also increased moral hazard incentive to take more risk. So in that way there are some restrictions, it's called branching restrictions. There are some legislation also in this regard. So then disadvantages, obviously you know that if competition is reduced when the market is becoming imperfect, that the competition declining, then obviously consumer charges increases, welfare loss to different stakeholders happen, decreased efficiency also become a part of as an outcome of it. Another, so we have seen the various measures for types of regulations. And one more thing before I summarizing this session, there are two types of supervision in the banking sector and the financial sector. And before the financial crisis, the regulatory authorities engaged in micro prudential supervision, which is focused on the safety and soundness of individual financial institutions. But aftermath 2007-8 crisis, that the global financial crisis has made it clear that there is a need for macro prudential supervision, which focuses on the safety and soundness of the financial system in the aggregate. Overall, what we have seen here is that financial institutions in their search for profits have strong incentive to avoid existing regulations by loophole minings. That also we have seen in the previous session, that is through money market and sweep account, there is always the financial institution, they will be searching for loophole mining. So in that way, what are the discussion, the regulation that we discuss here, all these regulation applies to a moving targets, because regulators are continually playing cat and mouse with the financial institutions, and financial institutions think of clever ways to avoid regulation, which then leads regulators to modify their regulation activities. So that means the regulators continually face new challenges in dynamically changing financial system, and unless they can respond rapidly, they may not be able to keep financial institutions from taking excessive risk. So here I am showing you some of the major financial legislation in the United States over time. Just to give you an overview, these are all the major legislations. So this is actually after the 2007-8 crisis. So many acts introduced in the US even after 2007-8 crisis as well. Also you can see several legislations that all actually you can see over time several legislations are coming, because they have to see when the financial institutions, when they try to overcome find loopholes, then again the regulators need to come up with a modification of the existing legislations, amendment of the existing legislations as well. So let me stop here and see you in the next session. Thank you.